All right, let's jump right into this explainer. Today, we're stripping things down and focusing purely on the basics, specifically a foundational financial concept known as the time value of money. Whether you're trying to grow your personal savings, running a startup, or just wrapping your head around the broader economy, understanding how time literally alters the value of cash, well, it's pretty much a superpower. We're getting right back to basics today to demystify what a single dollar is actually worth as it travels through time. And honestly, once you see money this way, you can't unsee it. So let's kick things off with a super simple scenario. If I offered you a choice right now, option A, I hand you $100 today, or option B, I give you that same $100 in exactly 1 year, which one are you rationally gonna choose? Assuming we're in a normal world with positive interest rates, economists call this your time preference. And the logical choice becomes glaringly obvious once you realize what cash can actually do while it's just sitting in your pocket. It is not just paper, guys, it's got potential energy.
The answer, for sure, is always today. And that brings us straight to the absolute golden rule of finance. A dollar today is worth more than a dollar tomorrow. Now, worth more isn't just some nice philosophical idea. It literally means its mathematical value today is demonstrably greater. Why? Simply because of its potential to earn interest. That dollar you're holding right now can be put to work immediately, generating even more value for you while you're fast asleep.
And that brings us to how we actually measure that potential, which is interest. See, when you save or lend money, you're sacrificing its immediate exchange value. You could have spent it on a nice dinner out, or maybe a new phone, but you didn't. So you're compensated for that sacrifice with interest. Think of interest like rent for your money. Just like a tenant pays a landlord to temporarily live in a house they don't own, a borrower pays you interest to temporarily live off your funds. It's just compensation for the time you and your cash are separated. Let's look at an example. If you take that $100 today and drop it into a standard savings account, boom, it goes to work for you immediately. In finance, we look a lot at the risk-free interest rate. Basically, that's the guaranteed baseline rate you'd get from a rock-solid institution, assuming zero risk of them going under or defaulting on you. For our purposes today, let's just assume this risk-free rate is a nice, steady 5%.
Now here's where the absolute magic of compound interest kicks in. With a 5% rate, your $100 today is mathematically identical to $105 in 1 year. But if you just leave it there, it compounds. It grows exponentially. By year 2, it becomes $110.25. Year 3, you're looking at $115.76. This snowball effect is exactly why you always take the money today. Given enough runway, a single dollar just starts multiplying itself over and over again.
Okay, so this actually creates two totally distinct directions for financial time travel. When we evaluate how much present money will be worth in the future, like our $100 growing into $105, we call that capitalization. We are moving forward in time. But what if we need to look backward? Well, that reverse operation, evaluating a future amount of money in the present, that's called discounting. It's essentially taking a future value and stripping away all that interest to see what it's worth right here, right now.
Which brings us to our core concept for this explainer, present value, or PV for short. Present value is the exact mathematical result of discounting a future amount of money back to today's date. Because money has that built-in interest-earning potential we just talked about, the present value of a future sum is almost always less than the future value itself. Unless, of course, you're in some bizarre economy with negative interest rates, where you literally pay the bank to hold your cash. But let's just stick to the basics, and normal markets for now. To see how this discounting works in real life, let's look at a pretty classic hypothetical. Imagine you just scratched off a winning lottery ticket. Awesome, right? But the catch is, you don't actually get the $1,000 cash prize for 5 whole years. You're holding that winning piece of paper right now in your hand. So what is it actually worth today? Well, it's definitely not $1,000, because you can't spend it or invest it yet. To solve this, we just need to isolate 3 basic variables. First up, the future cash amount, which is our $1,000. Second, the time horizon, meaning the number of compounding periods. In this case, it's exactly 5 years. And third, the effective annual interest rate. Let's say the prevailing market rate you could easily get right now is 10%. With just these 3 pieces of the puzzle, we can figure out the true current value of your prize. Using some really basic discounting math. So taking that future $1,000 and stripping away 5 years of 10% compounded growth, the present value of your ticket is exactly $620.92. If someone offered to buy that ticket off you today, this number is your mathematical baseline for a fair deal. Accept anything less, and you're literally losing money. Accept anything more, and hey, you're coming out ahead. In standard economic terms, at an effective annual interest rate of 10%,
you should be completely indifferent to having $620.92 today or waiting for $1,000 in 5 years. Why? Because that $620.92 invested today at 10% interest is going to grow to exactly $1,000 in 5 years. The two options have absolutely identical purchasing power. They are the exact same value. You're just viewing them at different points on the timeline.
All right, let's move on to Section 1, Net Present Value, or NPV, making sense of messy, real-world cash flows. So now we're going to take the basic concept we just learned and apply it to how businesses and major investors evaluate complex, real-world projects. Imagine a business venture that spans 3 periods. Conventionally, we use a positive sign for money coming in and a negative for money going out. Say you receive $100 at the end of period 1. Great. But in period 2, you have to buy some expensive new equipment to keep things running, so you're paying out $50. Finally, in period 3, you get a final payout of $35. With an interest rate of 5%, how do we value this chronological mess? Actually, it's not as hard as it looks.
Because here's the absolute beauty of present value. It is wonderfully additive. Instead of trying to solve one massive, tangled algebraic nightmare, we just discount each individual cash flow back to today using our 5% rate, line by line. That $100 in year 1 becomes $95.24 today. The $50 cost in year 2, that effectively costs us $45.35 today. And that $35 in year 3 is worth $30.23 right now. We've just normalized everything to the present moment.
Now, by adding all those individual present values together, taking the positive inflows and subtracting the negative outflows, we find the net present value. For this entire stream of cash flows, it's exactly $80.12. By converting everything into today's dollars, we instantly see that this project adds positive, tangible value to the business today. It's a total green light.
This basic math gives investors a really brilliant step-by-step toolkit to directly compare entirely different projects. You project the expected future cash flows. You discount them all to present value using the exact same rate, and then you just stack them up. The rational choice is always the project with the highest present value, because that's the one that delivers the most wealth today with the least initial outlay of capital.
But of course, we can't ignore risk. The discount rate isn't just about time. It is very much about uncertainty. If an investment is risky, let's say it's a bond from a highly volatile startup that might not even exist next year, investors are going to demand a risk premium. They use a much higher interest rate to protect themselves. And mathematically, dividing a future sum by a higher rate aggressively shrinks its present value. Simply put, higher risk equals lower value today. The more dangerous the bet, the less it's currently worth. So, as we wrap up this explainer, I want to leave you with this one thought. Understanding capitalization and discounting, it really gives you a superpower. It allows you to peer through time and strip away the illusion of future wealth so you can see its actual worth right now. So next time you're offered a payout tomorrow, pause, do the math, and ask yourself, what is its real value today?